Welcome to our Taxes and Retirement 567 webinar. Before we get started, I'd like to go over some housekeeping items. If you have any questions during the presentation, please post them in the Q&A section on the right-hand side of your screen. They are private and can only be seen by today's presenter. There will also be some poll questions that we would love your feedback on. Lastly, there will be an opportunity to schedule a complimentary consultation with today's presenter. There'll be a pop-up that comes across your screen. If you're interested in scheduling an appointment, you can click the schedule here and you'll be directed to their calendar. This will be posted a few times during the presentation. Now, I'd like to introduce today's speaker, Karen Boschert.
Thank you, Emily. So yes, welcome to our webinar on how tax planning changes through the 4 stages of retirement. My name is Karen Boschert. I am a senior wealth advisor with Exencial Wealth Advisors. I thank you for joining us today to learn more about taxes and retirement. So a little background about myself and my firm. Exencial is a national registered investment advisory firm. We help our clients with tax preparation, individual investment management, financial planning, estate plan construction, risk management, and philanthropy. I'm asked quite often what our name Exencial actually means. And this is a name that we created combining 2 of our core values, exemplary and essential. So our firm began in 2003. I started my career as an advisor in 2007. Currently, I am based in Cincinnati, Ohio, but I have clients all across the U.S. So from time to time, I do present workshops and classes on various financial education topics, such as Social Security, retirement planning, IRA planning, estate planning, among other things. My goal is always to inform and educate so that you can understand how critical these financial planning topics can be and how they affect you and your family. When I started in finance, I truly knew nothing about it. A small fact about me is that both of my older brothers do the exact same thing I do. We are all wealth advisors. As a kid, though, I had no interest in this topic. It was very daunting to me. But when I started out my career, I was very fortunate to work for a really great company that taught me and trained me on everything I needed to know. And this field really became my passion. And I love what I do every day because I can help people like yourselves plan and execute on your financial goals. And that's why I do these presentations, because I've seen many people make mistakes and pay more in taxes in retirement than is necessary. I hate seeing that. Those mistakes can be very costly to my clients because in retirement, people have less income oftentimes, and we have to find ways to make our portfolios last. Taxes can seem complex. They are often jargon-filled, even though the underlying concepts are fairly straightforward. So let me just take a second to explain how this workshop will unfold. The presentation is organized into 4 keys. Each key builds upon the previous one to form a solution to the presentation problem, as you'll see. So you may have questions as we go along. I do need to respect everyone's time today, so I won't be taking live questions during this presentation so that I can just be sure that we do end on time. There is a private question and answer box on your screen that Emily pointed out to you. This is completely private between you and my team. I do have an associate joining us silently in the background that may be able to answer or respond to some of your questions as we go along, but largely I'm going to delay answering the majority of your questions so that I can directly respond to you. I will be following up with you. And you are also, of course, welcome to schedule the complimentary consultation and where we'll be discussing your specific situation after this session. I have a couple questions also that Emily will put up on the screen during today's session just to help me understand a little bit more about my audience today. I also like to have full disclosure and let you know this is not a sales presentation. There is no sales pitch. This is purely educational for your benefit. The webinar obviously is free to you. The follow-up consultation is also, of course, complimentary, and there's really no cost associated with any of that. There is one other important point that I need to make, And that is, everybody's tax situation is different. So you always should consult a qualified professional tax advisor to discuss your specific tax situation, especially about these topics, because we'll be talking about traditional IRAs, the tax deferred money. You must pay taxes on distributions or conversions at the ordinary federal and state taxes. Then we've got the Roth IRAs, so the non-deductible money, where money is growing tax-free and the earnings can be withdrawn tax-free in accordance with the IRS rules. And then there's state taxes. So this presentation is primarily referencing federal taxes. You still may face state taxes. So check with your tax professional. I am a financial advisor. I do not provide tax advice, but what I do is help people understand how the tax code and other rules could impact your financial planning and investments. And then we develop a plan to take into account many of the different things people encounter, especially around taxes in retirement. So our goal here today is to help you understand that the retirement distributions, so spending your assets in retirement, is much different than the accumulation phase when you've been saving for retirement. We will go ahead. We're going to put up our very first poll question here. It's very simple. I just want to know are you currently retired? And that's just a yes or a no. So chances are you have been in the accumulation phase of your life for several decades. You've been working hard, saving your money, and then hopefully your accounts have indeed grown. But now as you enter and prepare for retirement, you're in an entirely different phase, the distribution phase. And this distribution phase has new, different rules that can catch people off guard. Along with those new rules, there's also often many changes in your personal life that can have a really big impact on your taxes too. So for instance, if your children are grown, that means no more child tax credits. If you've already paid off your home, that's fully paid off. There's no more mortgage interest deduction. If you're already retired, you may not be receiving any longer your tax-free employer-paid medical insurance. If you have stopped working, you also will not have that ability to put some of your income into a 401k or a similar plan to help manage your annual taxable income. And at some point, you will start taking Social Security, and sooner or later, when you reach age 72, you'll have to start taking required distributions from your retirement accounts. And that list of changes, it goes on and on. Many aspects of retirement will affect your tax bills in ways totally different from your working years. And understanding what these are and how they can impact you is absolutely crucial. So that brings us to what we're here to discuss. So simply put, people often pay more in taxes in retirement than they expected because of a confusing system that treats various income types differently and contains hidden taxes and penalties. In the accumulation phase, people build their assets in several different forms. So stocks, bonds, real estate, pensions, 401k, IRAs, and there's more even than that. When you're in the distribution phase, though, your regular wages stop coming in. You have to take the money that you've been saving and now use it to fund your retirement. And that could very likely go on for decades with good health on your side. Now that's challenging because you need to make informed decisions about the tax implications of tapping into those different accounts, and that can be costly. In retirement, your tax rate can vary dramatically based on the decisions that you do make, such as the timing and the order in which you use different sources of income, different sources of money to pay for your expenses. And poor choices through misunderstanding or ignorance of the rules can result in people paying more taxes than was necessary. As a result, you might see your savings drop faster. That can mean that you've got less to leave to the kids and the grandkids. Now, of course, we don't want that to be you. And the fact that you're here means that you're willing to work towards a solution, which is obviously the first important step. So developing a solution, because your tax exposure will change throughout the 4 stages of retirement, you'll need a strategy that anticipates both traditional taxes and possible taxes, surcharges, penalties related to Social Security, Medicare, and other income sources. And that means that you'll need an informed and proactive plan that will address how you create your income in retirement. So my goal is to introduce to you the major aspects of such a strategy and show you the challenges that we face, and then explain what makes up a workable solution to our retirement tax problem. The first step in developing the first step is to develop an understanding of the type of taxes you may face. What do I mean by taxes? That's going to include all of the costs that can potentially increase as your income does, including some that aren't even actually called a tax. But to me, if your cost is going up as your income rises, that's a tax in my book. You also need to understand the retirement expenses that you'll face, and you'll need to create a strategy that will help you decide which of your assets to tap first. How much should you be taking from those assets, and when those distributions should actually occur. Getting that right will help you pay as low of a tax rate as possible. Before we go on, we have 4 stages of retirement that we'll discuss. And these are rough ranges and descriptions. Your experience may differ. This is just a framework for discussing our topic. So first, there's pre-retirement, the final work and save years. We can put that in the range of age 50 to 60. Next are the early years of retirement, so maybe ages 60 to 70. We call those the go-go years. People often have grand plans for this time, like traveling, volunteering, starting new hobbies, working part-time, and spending more time with family. Next, you reach the middle years of retirement, so age 70 to 80, the go slow years, they sometimes are called. And that brings more financial decisions. So something like how to deal with your required minimum distribution from your IRAs and other retirement accounts. And then finally, there's the later years of retirement, where maybe your health might not be as good and you're thinking about your legacy and estate. So they can often sometimes be called the no-go years. And that starts oftentimes around age 80. So now I will have Emily put up our second, and it's actually our last poll question for us here. Just want to have an idea of which phase of retirement are you? Pre-retirement, early, mid, or late retirement? So, as you may already know, retirement can be full of surprises, and even the best planning will divert from reality at some point. So our future unknown is quite often inflation. People tend to view their future costs in current dollars and don't always anticipate how those costs grow with inflation. So think back 30 years ago to the cost of a gallon of milk, or a gallon of gas, or perhaps a visit to the emergency room. Now think about those costs today and what they'll grow to potentially over the next 30 years when you're not working. And that is inflation right there. So next, how about longevity? Many people end up living far longer than they ever expected. And that requires more money at a time when it's going to be quite difficult to work. So how long do you think you will live? Do you have longevity in your family? Many people are also underestimating exactly how much money they need to maintain the pre-retirement standard of living. Clients come to me often for retirement planning, assuming that they will spend less in retirement. And while that can be true in some circumstances, after we go through the financial planning exercise, my clients are much more informed and aware of what their true retirement expenses will be. And then lastly, there's healthcare costs. That includes out-of-pocket payments for services and drugs, plus Medicare and insurance costs, which will keep rising. Healthcare expenses are quite often the largest expense in retirement. So now at this point, you might be thinking, okay, so what's the first thing that I need to understand about retirement and taxes? So here it is. This is our first key. You have to know what your after-tax retirement savings picture looks like before you actually retire. So here we have a $500,000 401k or IRA balance, but it's not really $500,000. The government has a claim on part of that money because those taxes have been deferred up until now. They'll get their share, though, when you're forced to start required minimum distributions once you turn age 72. Obviously, the higher your tax rate in retirement, the less your account will be worth. So here's an example. This chart shows you the cumulative after-tax amounts that you could potentially expect to receive from that $500,000 IRA, earning, say, 6% a year at the various different tax rates. And as you see here, the lower your tax rate, the more you keep. So it's very simple in theory. It gets to be more difficult, however, in practice. And by the way, of course, this presentation applies to both pre-retirees and retirees. So don't worry if you've already started your retirement. Tax planning is important throughout your retirement. So now you might be thinking, all right, Karen, my accounts may not be worth as much as I thought, but I'll still have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay for my healthcare costs. But one thing you need to understand when creating your retirement tax strategy brings us to key number 2, is that Social Security and Medicare have their own tax traps that you need to plan for as well. So now we're going to lead into Social Security, and we'll also include Medicare here. But there are different retirement approaches. So let's look at the aspect of Social Security and taxation and how people approach retirement. So during the go-go years stage, some people retire altogether, but other people enter it into sort of like a semi-retirement. So sometimes it's a continuation of a previous job, maybe just fewer hours. Others might use semi-retirement to explore an interest in a new field. And then we've got others that might use semi-retirement to pursue maybe non-paid, more rewarding type volunteer work. So working in retirement definitely can impact your planning and taxes in a number of ways. So let's look how working during these years could be a good thing. So chances are you've already researched what your Social Security benefit might be at various ages, but you may not know that your Social Security benefit is calculated using your highest 35 years of earnings. Well, what if you started working later in life? Or what if you left work to raise children or family? You might not have all of those 35 years of earning history. So suppose you only have 28. The remaining 7 years actually count as big fat zeros when they're calculating your benefits. But there's good news. So earnings at any age can still help you increase your Social Security benefit. And thanks to how Social Security calculates their benefits, replacing some of those years that have a zero, even with a modest earning, can make a positive impact on your benefit. So now let's look how working during those go-go years could be somewhat bad if you're already collecting your benefits and unaware of how the Social Security earnings limit that applies prior to reaching your full retirement age. So here's how the rule works. If you start your Social Security, be it your own retirement benefit or a spousal benefit, prior to the year you reach your full retirement age, for every $2 above a certain amount that you make, which for earnings in this year, 2021, would be $18,960, Social Security will withhold $1 of your benefit. So I'll just repeat that. For every $2 above a certain amount, above that $18,960 that you earn, Social Security is going to hold back $1 of your benefits. So keep in mind, what we're talking about here is earnings. So I'm talking about W-2 salary, self-employment income. This does not refer to pensions, interest, dividends, capital gains. That's a completely different type of income. They don't count and they will not reduce your early Social Security benefits. But for instance, let's say that you earn $20,960 this year. That's $2,000 over the limit. Therefore, under that $1 withheld for every $2 earned rule, Social Security would withhold $1,000 of your 2021 benefits. But those benefits are not truly lost. When you turn full retirement age, your benefit will be adjusted to make it as if you had applied at full retirement age with respect to those withheld benefits. In other words, your benefit going forward would be a little bit higher. Also, in the year you reach your full retirement age, there's a separate higher earnings limit. So moving on, we're going to jump into talking a little bit about Medicare. So the biggest thing with Medicare is making sure that you enroll in Medicare at the right time. It's a very critical decision. If you do bungle that, you're going to get hit by a lifelong penalty. So to help understand, we're going to take an example. We're going to look at this couple, Jim and Ann. They're both age 68. Jim retired at age 65, Ann retired at 66. And prior to retirement, the couple had health insurance through Ann's employer, and they continued that after Ann retired because, nice enough, her employer offered retiree health benefits. Unfortunately, what they didn't know is that they still had to enroll in Medicare Part B as soon as Ann retired. So even though her employer offers those health benefits, those benefits are generally paid secondary to Medicare after retirement. But Jim and Ann didn't realize that mistake until it was too late. And thanks to the way Medicare enrollment periods work, they weren't able to begin coverage until the next year. So in a worst case scenario, this might have resulted in a gap in coverage for Jim and Ann if they say had a major medical need. But even in the best case scenario, because Jim and Ann missed their deadline to sign up for Medicare Part B, they will each owe a 10% Medicare Part B base premium penalty, and that is for life. So you can see how much that translates to here in real dollars. They owe this year as their penalty $356 extra. Historically, we can estimate that premiums will go up. They do get higher. So that 10% penalty will grow and grow and grow. And over the course of a lifetime, that could easily translate into a $10,000 mistake for this couple. So we've seen how Social Security and Medicare have their own tax traps and unique rules and penalties. So if you're like some who've seen this presentation, you might be asking yourself, okay, are there other tax traps that I'm going to be facing in retirement? Well, the rest of what we'll cover here today isn't like what we just saw with the Social Security tax. The public generally wasn't aware of those tax squeezes. But what we're going to see now is how the tax code in plain view can snag a retiree, especially if there is no planning done. And that's going to take us to our third key. So you must plan how and when you will use taxable, tax deferred, and tax-free assets to manage your income and your tax brackets efficiently. You can't be haphazard about tapping your tax deferred savings. Timing is really everything with this. And if you don't plan carefully through all those stages of retirement, you will encounter unintended tax consequences. So let's take a look by first addressing the question that I hear so often, pretty much every day right now, and that is, what account do I spend first? So let's take a common example. This is a couple, Sam and Mary, and they've been very good savers, as you can see here, and they're looking forward to spending their retirement years. They want to travel, spend more time with their grandchildren. And then in addition to their Social Security benefits, they have $450,000 each in an IRA, $60,000 each in a Roth IRA, and then they have a joint bank account valued at $300,000. Now their goal is to spend, or their expected expenses are going to be around $8,500 a month, which would be right around $100,000 a year. So where are we going to take this money from first? So a lot of people think take the money out from the after-tax money in the bank, and then we'll go to the tax-deferred IRA money, and then lastly, we would touch the Roth IRA money. We call that conventional wisdom. That's been promoted by pretty much all the big investment firms for quite some time. And it's not a bad plan, but we just know now that conventional wisdom isn't always the best approach. So here, let's see an alternative approach. There's two key elements in the earlier years. First, use the taxable bank money for expenses, but also during that same period, accelerate IRA distributions during otherwise low income years, putting that money into a Roth account. This is called filling your tax bracket approach, and we're going to discuss that further in a second. The alternative approach gives you more flexibility to use that tax-free Roth money strategically in your future years. Now, does it make a big difference? I mean, I think so. We've got studies that show that this approach has been shown to increase portfolio longevity by up to 2 years. That can really make a difference. The big takeaway here, of course, is that you've got to plan all the way through retirement, especially around how you handle your tax deferred assets. And then, of course, my legal disclosure, always see a tax professional for the tax advice on that. So one way to help manage your income both before and during retirement is to utilize Roth IRA conversions. So a Roth IRA conversion is a simple process that allows you to move money from an IRA or another pre-tax retirement account like a 401k into a Roth IRA. In general, the amount that you convert is added to your income for the year and would be taxed at your ordinary rate. So for example, this client, Jill, if she converts $100,000 from her IRA to a Roth IRA, she would have to add $100,000 to her income. The conversion income would be taxed then at Jill's rate. And so for those reasons, that's why we do recommend prior to doing any conversion that you would talk with your tax professional. So the conversion doesn't need to be all or nothing, which is nice. There's one helpful approach for the conversion is called filling up the bracket. So often you might find yourself in the middle of one of these tax brackets here with room to add more income without pushing yourself into the next higher bracket. So for example, this year, 2021, the 22% tax bracket for a married couple filing a joint return goes from about $81,000 to about $172,000. So if you file a joint return, your taxable income is $100,000. That means you could add another $72,000 of income without pushing yourself into that next tax bracket, making an a Roth IRA conversion like this very sensible. So if you do plan to convert a large IRA, this approach can be more tax efficient than converting the full amount all in 1 year. So instead, you could make smaller Roth conversions over a number of years, filling up your bracket each time. And this can help reduce the average tax that you'd be paying on the converted money, and it also would spread out the tax bill for a longer period of time. So Roth IRA conversions can be especially powerful in those years when your taxable income is lower, such as having a high non-recurring medical expense deduction or a low sales year for a business owner. It can also be common for people who retire early and they aren't yet receiving their Social Security benefits, or if they're lucky enough to have a pension or taking those IRA distributions yet. So they might be in a lower tax bracket during that period, making it a good idea or a good time to complete one of those Roth conversions in those pre-required distribution gap years. So we've seen throughout our presentation the critical importance of managing our tax-deferred accounts. Because once you're age 72, you're forced to take out required minimum distributions. They're sometimes referred to as RMDs or MRDs, and that can be troublesome for your tax bill. But some people do make charitable donations during the year. They like to support their favorite nonprofit with an annual gift. So let's look how your required distribution and charitable giving may work for you with some planning. So let's look at this couple, Albert and Shirley. They're in the 24% tax bracket. Now the standard deduction for a married couple filing a joint return this year is $25,100. But Albert and Shirley are over age 65, so they actually get an additional standard deduction, bringing the total standard deduction for 2021 to about $27,800. So that means that they will get no tax benefit for any itemized deduction unless their total would exceed that $27,800 mark. So if Albert and Shirley have $15,000 of existing itemized deductions, say from state and local taxes, deductible medical expenses, mortgage interest, what would happen tax-wise if they wanted to donate $5,000 to a charity? They'd get no federal income tax benefit for making that charitable contribution because it's not going to exceed their standard deduction, which is that $27,800. Doesn't mean don't do it. It just means let's understand that it's not going to help you on saving taxes. So if you are over age 70 and a half and you have an IRA or an inherited IRA, there's another way that you could give to charity other than simply writing a check. And that's called a qualified charitable distribution. sometimes can be called QCD for short. So let me explain how that works so you can see why this qualified charitable distribution could be powerful in your situation. So there's a few of the rules. As long as you're 70 and a half or older, you're able to make this qualified charitable contribution of up to $100,000 each year from your IRA. And if you're married and you both are over at age 70 and a half or older, both of you have an IRA, then you both could make that $100,000 qualified charitable contribution from your own IRA. Second, any qualified charitable distributions you make will count towards satisfying your required minimum distribution for the year, which is great. However, when you make the distribution from your IRA, it must go directly from the IRA to a qualified charity, or you could potentially receive a check from your IRA custodian made payable to the charity. And then third, and this is the little different part, as long as you give to the charity, you're not going to get that income tax deduction. So why would I suggest this strategy where you don't get a deduction for giving to charity? Because when you make the qualified charitable distribution, the distribution from the IRA is never counted as income when you file your taxes. So let's take a look at how this will help Albert and Shirley. First, let's suppose Albert and Shirley do what a lot of retirees do. Albert takes his required distribution, $5,000 at the beginning of the year. He deposits it at the bank. He's done with his required distribution for the year. Now, being charitable people, they donate $5,000 to a charity. The end result is that the charity gets their $5,000. But let's look a little bit closer. So by virtue of giving to the charity this way, Albert and Shirley's $5,000 charitable contribution will actually cost them a total of $6,200. So why is that? Because that $5,000 required minimum distribution that went from the Al's IRA to his checking account at the beginning of the year is still taxable to him. So remember, the couple's in their 24% tax bracket, and then 24% times 5,000 equals $1,200. So that's where the $1,200 of additional tax that Al and Shirley must pay when they file their taxes. And that means the total cost of their charitable gift is $5,000 plus the $1,200, or $6,200. So remember, that gift didn't impact their standard deduction. The required distribution behind the gift is added to their income. So now let's see what happens if Albert and Shirley were to use this qualified charitable deduction to give the $5,000 to their charity. So instead of requesting that $5,000 distribution from Albert's IRA to go into the bank, he would simply have his IRA custodian transfer the $5,000 required distribution from his IRA straight to the charity. This satisfies Albert's yearly required minimum distribution because he's now over age 72. And the charity is in the same position. They still receive that same $5,000 donation. So everything's very good there. However, Albert and Shirley are now in the better position. They gave their $5,000 to charity. So the goal is still there. It still satisfies that piece of it. But even though they didn't receive a deduction for making the contribution, their IRA distribution is excluded from the tax return. Therefore, they owe no income tax on that $5,000 distribution. Their total cost to give the $5,000 to the charity is $5,000, a $1,200 savings over our previous example, simply by knowing how to use the tax rolls to their advantage. And they did it all without ever even needing a deduction. So as the saying goes, charity starts at home. So it can be a natural question to ask, how does retirement tax planning figure in here? And it's a very good question because the government still wants its share of those tax deferred assets when you pass away. And as we've seen, how you set things up can really matter, which leads us to our final key, number 4. And that is to organize your assets for your family's benefit, because estate planning still definitely matters. So estate planning is always going to be a relevant topic, although a lot of people don't like discussing death. That can be very uncomfortable. However, we're not going to discuss this in the traditional way. So the new tax laws that that's in existence excludes estates valued up to $11.7 million from the federal estate tax, meaning only really the tiniest fraction of people need to worry about estate taxes. But just note, you still may face an estate or inheritance tax at the state level. Still, though, very important tax issues remain around how your assets are received by your beneficiaries after you die. One of the examples is making sure that married couples plan for their available step-up in basis. So that's a tax term that gets thrown around quite a bit. So simply put, what a step-up in basis is it's a tax roll that readjusts the value of an inherited asset. So the value is not what your spouse or the decedent paid for it initially. Instead, it's stepped up to its price on the date of death. And that can make a huge tax difference, as we're going to see here. So it's likely that most of the assets that you own outside of retirement accounts and annuities would be eligible for this step up in basis. So let's take a couple, Phil and Mary. They live in a separate property state, which if you're in Ohio like I am, we are a separate property state. So let's say that they're married, they own a variety of taxable accounts in a joint account, which would be known as a joint tenants with rights of survivorship account. And let's say those investments have accrued long-term capital gains at a value of $120,000. So unfortunately, some bad news arrives one day and Phil is diagnosed with terminal cancer. He has only 18 months to live. So let's take a look at how this is going to work using two different scenarios. So the first scenario, Phil and Mary make no planning changes to their assets. When Phil dies, Mary will receive a step up in basis on Phil's half of the joint account, which would be $60,000. She, however, will still face a future $60,000 of unrealized gain on her half of the account. Simply put, that means if Mary decided to sell that entire account, she'd owe tax on her $60,000 of gain. So now let's suppose that upon this terrible diagnosis for Phil, Mary and Phil moved all of their investments upon the advice of an advisor into one account in Phil's name. This way, as long as Phil lives longer than 1 year, Mary would receive a full step up in basis on the entire $120,000 account. So simply put, Mary would be able to sell that account and there'd be no tax. And let me say, planning around death, it really can be difficult, but that's where professionals like myself can help, because we're emotionally removed from the situation. We can help you make those good decisions when it seems really difficult at the time. So now let's take a situation. Maybe you're someone who's managed to save up quite a bit in your IRA or your 401k. And you feel really confident that you'll be pretty comfortable in retirement, and you're hopeful that you'll leave the accounts behind to your children. So in the past, we've recommended that because with the right structure, your heir could withdraw the money throughout their lifetimes, possibly over decades, but that changed recently. So there was the passage of what's called the Secure Act, and that went through in December of 2019. And that means now beneficiaries of inherited accounts, with a couple exceptions, must withdraw all of that money within 10 years of their owner's death and pay taxes, of course, on that money. And this restriction on what sometimes they're called stretch IRAs, inherited IRA, sometimes a beneficiary designated IRA they can be known as. This shines a light on how important tax planning really can be, because the laws can change at any time, and we're expecting that the laws will change soon enough as well too. But you do need to have a plan. You need to revisit that plan very regularly. So we'll take an example. Let's look at Pamela and Kyle as an example of what choices beneficiaries could have when they inherit those IRAs and now can no longer stretch those distributions over their lifetime. So the first scenario we have will involve Pamela and her son Kyle. Pamela unfortunately passes away and she leaves the full IRA account to her son Kyle. He's an only child. He's the sole beneficiary of this IRA. So now we know Kyle has only that maximum of 10 years to withdraw all of those IRA monies in order to meet the required minimum distribution rules. Well, let's say Kyle likes regular distributions, so he chooses to take equal distributions of the funds over the 10 years. With an assumption earning rate on the IRA around 6% annually, that payment would calculate to about a little over $54,000 each year for Kyle over those 10 years. And Kyle, of course, would have to add that amount as income on his tax return for each of those 10 years. Now, the second scenario for Kyle is going to look a lot different. So let's say Kyle forgot he lost track of time, and he's already reached year 10 of the required minimum distribution window. Since it's year 10, he now must take the full distribution out in 1 year. So if we assume that same earnings rate of 6% on that IRA that was valued around $400,000, we would calculate that the IRA balance has grown now to over $700,000, and Kyle would have to take out that full IRA balance as a distribution in year 10 and pay income tax on that amount. So Kyle would now be in the top tax bracket that year. It's a really big difference. So, all right, so we're nearing the end, and you might be thinking, goodness, all right, Karen, how in the world are we ever going to manage that? So let's kind of bring everything together here. So we started today with an understanding of what our problem is, and that's that retirees are often paying more in taxes than they ever expected because there's a confusing system that treats various income types differently and contains hidden taxes and penalties. So let's do a little review on what we've learned in the context of these 4 stages of retirement. Under the pre-retirement heading, we saw the importance of understanding the after-tax value of your pre-retirement savings before you retire. We also saw that in those pre-retirement years, it's critical to consider your tax-deferred savings and start taking advantage of funding Roth IRA accounts to fill up your bracket, something that you do through your early retirement years when you're in those lower tax years. We also looked at Social Security and taxes, plus the importance of couples having a benefit strategy that considers the surviving spouse. We saw the importance of signing up for Medicare on time, right in the middle of those early go-go years. And that's because starting in your middle retirement years, you will be confronted with those required minimum distributions. And we've seen the importance of planning your income needs before then and what tax issues would be involved. And then lastly, we saw the importance of setting up your assets and managing them during the later years of retirement so that you can preserve the most for your heirs and leave them with the most tax flexibility. And all those items together lead us to this obvious solution for that problem. So because your tax exposure will change throughout retirement, you need your strategy to include these 3 bullets. So needs to anticipate how and when you would be tapping your assets to cover your personal expenses. Must understand the range of taxes that you would be facing at the various stages throughout retirement. And then managing your actions so that you are paying the lowest tax rate possible. So there are so many things involved with tax and retirement planning, but what I'd love for you to do or start thinking about is how you're going to use your accounts in terms of those tax buckets, and start thinking about, how am I going to get this income plan in retirement as you begin to transition from that accumulation phase over to the distribution phase, because things are much more complex, and obviously we've seen mistakes can be made. So I do offer up a 15 to 20-minute complimentary phone call after this webinar where we would be able to take a look at these topics that I discussed here today and how they apply specifically to your situation. So I'm here to help. My role is really to offer some ideas and help you get on the right path. The way that I've found that it's probably easiest for us to coordinate those consultations is by calling you to see if you'd like to talk further and when we could set up that consultation. So the next day or so, you will get a call from me, potentially from my associate as well, but most likely from me to set that up. And that's all complimentary to you. There is no cost. There is no obligation on this. My calendar link is also here for you if you'd just like to schedule your own time for your consultation. But that concludes what we were going to discuss today. I really appreciate and thank you for attending today's session. I hope that you're leaving here today with a better understanding about taxes in retirement and how you'd be planning for your income in retirement. I really look forward to connecting with you each individually when I call out to you in this next day or so. So thank you again. I hope you all stay healthy and take care.